Welcome to the Deep Dive. Today we're tackling a really fascinating question about, well, a company that looks like a traditional utility on the surface. Alliant Energy, ticker LNT.
That's right. The big question is Alliant quietly gearing up for some really explosive growth, powering this AI-driven world?
Or has the market maybe gotten ahead of itself, already pricing in a future that's still pretty far off and, frankly, not guaranteed?
Exactly. We're going to dig into whether Alliant is truly becoming this critical digital age infrastructure provider.
Or if the huge cost, and let's face it, the risks of this whole energy transition are just, well, too high.
Just so you know, all the data we're using is current as of June 24 in 2025.
And we're using a reference share price of $60.01 from June 17th, 2025.
Our mission today really is to give you a solid value-focused look at Alliant Energy, its competitive position, what it might actually be worth.
Yeah, we want to go beyond just the headlines and figure out what really matters for understanding where this company is headed, helping you weigh the potential against those significant challenges.
So let's jump right in. How does this utility actually work?
Okay, let's unpack this with Chapter 1, Business Analysis. Fundamentally, LNT is a regulated public utility holding company.
Right, and that means it mainly operates through its two big subsidiaries, Interstate Power and Light, that's IPL in Iowa and Wisconsin Power, and Light WPL over in Wisconsin.
And that structure leads to their core business model, right? The cost-plus thing.
Exactly, the cost-plus model. Alliant puts a lot of capital into essential infrastructure, power plants, lines, gas pipes. And then state regulators, the Iowa Utilities Board and the Public Service Commission of Wisconsin. They allow Alliant to earn a predictable return on those investments. It's capped, of course, but predictable.
So revenue comes from selling electricity and gas.
Primarily. To about 1 million electric customers and maybe 430,000 natural gas customers. There are some minor non-regulated bits too, but the bulk is regulated sales. And those recent base rate increases they got, those are pretty important drivers for their current revenue stability.
So in its service areas, LNT is basically the only game in town, a regulated monopoly.
That's it. Entrenched, dominant. Customers don't really have a choice.
And for investors, that means stability. It's a big player, regionally, market cap around $15.4 billion, and its rate base, the assets it earns returns on, was $14.2 billion in 2024.
And their value proposition is sort of twofold. For customers, it's reliable power, essential stuff.
Right.
But for investors, it's this interesting mix of, historical stability plus this new, pretty compelling growth story.
Driven by?
Well, their strategy focuses on sustainability, the energy transition, yes, but crucially positioning themselves as a key power provider for all these new data centers.
Okay, and you mentioned something about them creating demand.
Yeah, that's what's really unique. Their strong economic development program. They don't just wait for customers. They actively partner with state and local governments to attract big energy users, especially data center.
How do they do that?
By helping with site selection, land rights, transmission access, even offering customized rate structures, it's very proactive. They're basically engineering their own growth, which is pretty unusual for a utility.
That is a powerful edge. And speaking of demand, the whole utility sector is changing fast, isn't it?
Yeah.
This AI and data center boom is huge.
It's unprecedented. U.S. power demand is set to hit a record in 2025, 4,163 billion kilowatt hours. That's after almost 20 years of flat demand, a complete reversal.
So how is Alliant plugging into that directly?
They're right at the forefront. They've already secured contracts for 2.1 gigawatts of new data center load.
Wow. How big is that relative to their current size?
It's massive. It's over a 30% increase to their 2024 peak demand. Just that one factor takes their expected load growth from the typical, 1-2% a year.
To something much higher.
Exactly. To a projected electric sales compound annual growth rate, CAGR, of 9 to 10% between 2025 and 2030. That fundamentally changes the whole investment case.
Okay, besides data centers, what other big trends are impacting them? Renewables, grid upgrades?
Absolutely. The big shift to renewables, especially solar, huge investments needed in grid modernization. The grid is aging, plus you have these new demands and things like smart grids, storage.
And AI itself is being used by utilities now too, right?
Yeah, for things like predictive maintenance, optimizing operations, reducing costs, that's becoming increasingly important.
Now, you said they're a monopoly for retail, but who do they compete with?
They compete for investment dollars, definitely. And for attracting those large industrial customers, like the data centers, peers would be companies like Xcel Energy, WEC Energy Group, Amerin.
But Alliant's edge is that focused strategy.
I think so. That focus on Iowa and Wisconsin, which are seen as business-friendly states, combined with that economic development program, makes them a sort of unique partner, especially for data center developers.
And underpinning all of this is the regulatory environment. You called it constructive.
That's the company's term. It means the regulators, the IUC in Iowa, PSCW in Wisconsin, plus federal agencies like FERC, provide a predictable framework for approving rates, projects, and returns.
But it also limits their upside. And maybe slows things down.
Exactly. It provides stability but caps profits and means major strategic moves need regulatory sign-off, which takes time.
And the barriers to entry are just massive.
Oh, immense. Think about the capital needed tens of billions for new infrastructure. Plus, the whole regulatory fortress getting permits takes years, decades sometimes. It grants them a de facto monopoly.
So customers are essentially captive.
Pretty much. For residential and most commercial, that creates a very predictable revenue stream. Plus, their large network gives them economies of scale, spreading costs over 1.5 million customers. It's a structural advantage.
Okay, that gives us a really good picture of the business itself. Now let's look at the people running the show. Strategy is one thing, execution is another. Let's move to Chapter 2, Management Evaluation.
All right. The leadership team features Lisa M. Barton as president and CEO. She joined in early 2024, came over from American Electric Power.
Relatively new then.
Yeah, but you also have John Larson as executive chairman. He's got deep roots, long tenure with the company. So it's kind of a mix of fresh perspective and long-term experience, suggests maybe a strategic refresh.
How do we gauge their effectiveness? Maybe look at how they handled something like the Inflation Reduction Act.
That's a great example. They were very proactive. They safe-harbored 100% of their planned renewable and battery storage investments through 2028.
Explain safe harbored. What does that actually mean in practice?
It means they took specific steps, like ordering equipment early, to lock in their eligibility for the current very favorable tax credits under the IRA.
So even if the rules change later.
Exactly. They've essentially de-risked a huge chunk of their growth plan from future political shifts. That shows real foresight and, frankly, good execution in navigating complex rules.
Then how are they on communication?
Transparency.
Chance.
I'd say pretty high. Their earnings calls, like the Q1 2025 one, are clear, lots of data. They provide detailed supplemental slide decks, too. That kind of openness builds investor confidence, which you definitely need when you're planning to spend billions.
Billions is right. Capital allocation must be absolutely critical here. What's the plan?
It's all about organic growth. They've laid out this massive $11.5 billion capital expenditure plan for 2025 through 2028. That's a big step up from previous plans.
And where's that money going specifically?
The priorities are clear. Funding the infrastructure needed for that huge new data center load.
So new power plants.
Yep. Heavily weighted towards new generation. 1,500 megawatts of natural gas, 800 megawatts of energy storage, 1,200 megawatts of new wind. Plus, significant upgrades to the electric distribution grid.
What about M&A? Buying other companies?
Very low priority. They are laser focused on putting that capital into their own regulated rate base where they can earn those predictable returns.
Okay, so reinvestment is key. What about returns to shareholders? Dividends? Buybacks?
It's all about the dividend. Really impressive record, 22 straight years of increases.
Wow.
Their target for 2025 is $2.03 per share. That's up 6% from 2024. And that lines up nicely with their long-term EPS growth target of 5-7% and a disciplined payout ratio goal of 60-70%.
And buybacks?
No significant buyback program. It's a clear choice. Reinvest in the business for higher long-term returns via the rate base rather than buying back stock.
Let's talk about return on invested capital, ROIC. How are they doing there?
Okay, ROIC is super important for utilities. Alliant is currently somewhere between, say, 4.7% and 6.12%. That's generally in line with the utility average.
But you mentioned their cost of capital earlier.
Right, and here's the critical point, that ROIC is currently below their estimated weighted average cost of capital, or WACC, which is around 6.55%.
So historically, they haven't been earning back their cost of capital.
On average, based on historical investments, not quite. But, and this is key, this isn't unusual for a utility right in the middle of a massive transformation. The investment thesis here is really a bet on management executing this huge capital plan and those new projects earning significantly higher returns, like the regulated return of 9.8% they can get in Wisconsin, which will eventually pull that overall ROIC well above the WACC. It's about future value creation.
That makes sense. It's a bet on the future payoff from these huge investments. Okay, let's dig into the numbers themselves. Time for Chapter 3, Financial analysis.
All right, market cap first. As of June 2025, Alliant Energy is sitting around $15.4 billion to $15.6 billion. So a decent-sized regional utility.
What about revenue growth over the last, say, 5 years?
It's actually been a bit inconsistent. There was a jump in 2022, but then declines in 23 and 24.
But you mentioned earlier, revenue alone can be tricky for utilities.
Exactly. Fluctuating fuel costs that get passed through can really skew the picture. You need to look at margins and earnings.
So how are the margins looking?
Pretty healthy, actually. For the trailing 12 months ending Q1 2025, gross margin was around 46.5%, operating margin about 23.7%, and net profit margin near 18.3%, even hit 19% in that first quarter. That suggests they're managing costs effectively.
Now, free cash flow, I imagine with all this spending.
Yep, consistently negative. And the deficit has been growing, went from $865 million in 2020 to over $1 billion negative, making $1,082 million in 2024.
Which sounds bad, but you're saying for a utility like Alliant right now, it's expected.
It is. It directly reflects that aggressive reinvestment cycle they're in. They're pouring cash into building future growth. You wouldn't expect positive free cash flow during this phase.
But what about earnings? Is that more stable?
Absolutely. Contrast the negative FCF with their earnings per share, EPS. It's remarkably consistent. Shows a steady climb over the last 10 years, $1.68 back in 2015, up to $2.69 in 2024, with just one minor dip.
So that consistent EPS growth is really the financial foundation here.
Precisely. That's the bedrock of the investment story. It shows the underlying regulated model is working, even with the heavy spending.
What about debt? Debt to equity?
It was 1.21 in Q1 2025. That sounds high compared to other industries, but it's pretty standard for capital-intensive utilities. Their stable, regulated cash flows allow them to carry more debt safely.
And liquidity. I remember seeing a very low current ratio, like 0.34. Isn't that usually a worry?
Normally, yes, but again, for a utility with predictable cash inflows and ready access to capital markets, it's less concerning. It just reflects their model. They finance long-term assets. They don't need to hold lots of cash or short-term assets.
Okay, and we keep coming back to the dividend.
Because it's central to their value proposition and financial stability. 22 years of increases, current yield around 3.35%, growing about 6% a year over the last 5 years. It's a key reason investors hold the stock.
All right, let's put a price tag on this. Valuation. How does LNT compare?
Okay, relative valuation. LNT's trailing PE ratio is about 20.7.
How does that stack up?
It's a bit higher than the utility sector average, which is around 19.8, but it's lower than the broader S&P 500, which is up at 23.5.
And compared to its direct peers, AEP, WEC.
It's right in the middle. AEP is lower at 18.1, WEC is similar at 20.0, XEL at 19.9, EXC lower at 17.2. So LNT is not the cheapest, not the most expensive.
What does that suggest?
It suggests the market sees the potential data center growth, but is also weighing those execution risks we talked about. It seems balanced, maybe fairly priced on a relative basis.
Now let's talk intrinsic value, what the company might actually be worth based on its future cash flows. We use a discounted cash flow or DCF model for that.
Right. The core idea is simple. A company's value today is all the cash it's expected to generate in the future, discounted back to present value.
And what is our educational DCF model estimate for Alliant?
Our model suggests an intrinsic value range of $58 to $68 per share.
Okay, $58 to $68. What are the key assumptions driving that range?
Two main things. First, the discount rate, which is the weighted average cost of capital, or WACC. We estimate that at 6.55%.
And second, the growth assumptions.
Yeah, we use a two-stage model. For the first 10 years, stage one, we're using management's own guidance, 5% to 7% annual EPS growth.
That aligns with their targets.
Exactly. Then for stage two, the long-term terminal growth rate, we assume 2.5% to 3.0% per year perpetually. That's basically in line with expected long-run inflation and economic growth.
So we've looked inside the company, the business, management, financials. Now let's shift focus to external factors, market views, risks. Here's where it gets really interesting as we move into Chapter 4. Market sentiment.
Okay, market sentiment. Wall Street analysts are pretty neutral overall. The consensus rating is a hold.
How many analysts and what's the breakdown?
Out of 10 analysts covering the stock, it's 4 buys, 5 holds, and 1 sell. So mostly sitting on the fence.
And what about price targets?
The average 12-month price target is $63.95. Compared to the current price around $60, that implies only about 6.6% upside. So analysts generally think it's trading near fair value.
But what about the general buzz, the media narrative?
That seems more positive. You see stories focusing on the strong Q1 earnings. The data center growth narrative is definitely getting traction, especially with news like the new Google facility in Cedar Rapids.
So a bit of a disconnect between analyst ratings and media tone.
A little, yeah. And you see mixed signals from institutions, too. Some big funds trimmed their positions, others added. It feels like cautious optimism overall.
What about short interest? Are lots of people betting against the stock?
Not really. Short interest is relatively low, about 2.77% of the float as of May 2025. That's around 7 million shares.
Is that high or low?
It's pretty low. It suggests there isn't widespread conviction that the stock is going down. The days to cover is manageable too, about 3.3 days. And short interest actually decreased recently.
Okay, now let's look at the technicals, the charts. How's the stock price doing relative to its moving averages?
That's where it gets interesting. The share price around $60 is actually trading below both its 50-day moving average, around $61.16, and its 200-day moving average, around $60.80, $60.95.
So positive fundamental news, but technically looking a bit weak. What does that divergence tell us?
It often implies that the market might have already factored in a lot of the good news. The stock could be consolidating, sort of taking a breather, while waiting for the next major catalyst or proof of execution. Short-term momentum looks negative. Long-term trend is maybe neutral to slightly bearish based on those averages.
Interesting. So the market seems to be saying, show me the money, essentially. Okay, let's explore who actually owns Alliant. That brings us to Chapter 5, ownership structure.
All right. Ownership is dominated by institutions. About 80% of the shares are held by large funds, which is very typical for a stable, large-cap utility like this. Provides a solid base.
Who are the big holders?
The usual suspects, really. Vanguard Group is the largest with about 12.8%. Then BlackRock with around 9.2%. State Street with about 6.4%.
That's a standard institutional presence. What are insiders, management, directors? Are they buying?
Insider holdings are very low, less than 1%, somewhere between 0.3% and 0.6%. Again, pretty common for big, mature utilities.
Any significant buys or sells?
We haven't seen any significant open market purchases by insiders recently. Most transactions are things like stock grants as part of compensation or related sales.
How should we interpret that?
It's generally seen as a neutral signal, maybe mildly negative if you're looking for strong conviction. It suggests insiders don't see the stock as deeply undervalued right now. Otherwise, you might expect them to be buying more aggressively.
And is that institutional ownership concentrated? Does any single fund have huge sway?
It's fairly concentrated at the top. Those top three, Vanguard, BlackRock, State Street, together, they control over 28% of the company.
So decisions made by those big managers could definitely move the needle on the stock price and liquidity.
Absolutely. Their actions matter.
Okay, we've looked at sentiment and ownership. Now for the really crucial part, weighing the specific challenges against the opportunities. Let's unpack Chapter 6, risk assessment.
Let's start with a SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths first. We've covered these: regulated monopoly status, strong infrastructure, that clear data center growth strategy.
The solid financials, 22 years of dividend growth, and that unique economic development program creating demand.
Exactly. Now for weaknesses. Heavy reliance on just two states' regulators is a concentration risk.
Right, Iowa and Wisconsin.
Geographic concentration too vulnerable to regional issues, weather, etc. That persistent negative free cash flow means they constantly need outside capital. And, as we discussed, the historical ROIC being below WACC is a weakness, even if it's explainable right now.
Okay, opportunities. This seems like the core of the bull case.
Definitely. The AI and data center demand explosion is number one. Then there's the long runway for renewable investments: wind, solar, batteries, boosted by federal incentives like the IRA.
Plus the need for grid modernization and the general trend of electrification, like EVs, providing a long-term tailwind for demand.
Precisely. Now, the threats. Potential disruption from distributed generation, maybe deregulation down the line, though that seems less likely now.
Cybersecurity is always a big one for utilities.
Critical risk, absolutely. And then there are evolving environmental regulations, could raise compliance costs, potentially force early retirement of older assets.
Let's zoom out a bit. Macroeconomic factors. How do things like interest rates hit Alliant?
High interest rates are a significant threat, really in two main ways.
Okay.
One, It directly increases the cost of borrowing money, which is a big deal when you have an $11.5 billion spending plan heavily reliant on debt.
Makes sense. And two,
It makes Alliant's dividend yield less attractive compared to safer investments like treasury bonds, whose yields rise with rates. That can put pressure on the stock price as income investors look elsewhere. It's a classic inverse relationship for utilities.
got it. What about geopolitical factors? Trade issues, you mentioned tariffs earlier.
Yeah, that's a tangible risk. Let's say, hypothetically, the U.S. imposes new tariffs in 2025 on imports from China, like steel or aluminum.
How does that affect Alliant?
Many components for their big wind, solar, and battery projects are manufactured in China. Tariffs would directly inflate the costs of those projects and could cause delays if supply chains get disrupted.
Has management addressed this?
They've indicated their current exposure is manageable, but it's definitely a risk factor to watch, especially given the scale of their renewable build-out plans.
All right, we have explored this from multiple angles. Let's try to bring it all together. Time for Chapter 7, Conclusion.
Okay, let's synthesize. The bull case for Alliant Energy rests heavily on its strategic position to capitalize on the AI-driven data center boom.
That 2.1 gigawatts of new demand.
Exactly, fueling that huge $11.5 billion investment plan, which is expected to drive double-digit growth in their rate base and deliver that consistent 5-7% annual EPS growth.
Plus the stability factors, the regulated monopoly, constructive regulators, the long dividend track record.
And a proactive management team that seems to be executing well, like with the IRA safe harboring. That's the bull argument in a nutshell.
Okay, now the counter-argument, the bear case. What are the main points there?
Execution risk is paramount. Their entire future hinges on pulling off this incredibly complex multi-year construction program without major delays or cost overruns.
Which is always a risk with big projects.
Always. There's also concentration risk, heavily tied to specific data center projects succeeding and maintaining regulatory goodwill in just those two states.
And the valuation?
The stock seems fairly priced already, suggesting the market has baked in a lot of this optimism. Analyst consensus points that way too.
Plus the headwinds we just discussed.
Right. Macro headwinds like high interest rates impacting financing costs and dividend attractiveness, potential trade tariffs hitting project costs. And fundamentally, the company is burning cash right now, and its historical returns haven't yet created value. It's a bet on the future payoff.
So bringing it back to valuation, remind us of the intrinsic value range from the DCF model.
Our educational DCF model estimated a range of $58 to $68 per share.
And the stock is currently trading around $60.01.
Right. Squarely within that estimated range.
So at the end of the day, what's the final takeaway?
I think an investment in Alliant Energy today is really a bet. It's a calculated bet, but still a bet.
A bet on what specifically?
A bet on management's ability to execute this massive, ambitious plan successfully, and a bet that the future returns generated by these huge investments will ultimately justify paying today's price.
Which leads to a final thought for you, our listener.
Yeah, it raises a really interesting question. What does it actually mean for your investment strategy when a company that looks like a stable, maybe even boring traditional utility starts transforming into a high-growth infrastructure played directly linked to the digital economy?
How do you balance that promise of AI-fueled growth against the very real costs, the execution risks, and the time it takes to build that future? Something to think about.
Definitely. And just a quick reminder, this deep dive was generated by an AI system. It's for educational purposes only, so please don't take it as financial advice.
Absolutely. Always do your own research or talk to a qualified financial advisor before making any investment decisions. And hey, if you found this deep dive useful, please like this video and subscribe to Stock Analytics AI on YouTube.
That's right. Members get priority requests for deep dives on specific tickers. Just leave them in the comments.
And we're planning to cover all the S&P 500 stocks exclusively for members over the next few months. Thanks for tuning in.